Hey Joe, how you feeling? You made it through your most recent bout of COVID.
Doing all right.
Yeah,
Certainly been better, but better than last week, that's for sure.
I got to say we missed you. Joey C doesn't quite hold up.
The only thing worse than being sick was not being around to have that China debate with you, Luke.
Yeah, I hope I represented your position well. I know we
Yeah,
talked about it briefly, but I didn't. I'm sure you could defend yourself a lot better than I could
you
defend
got a
you.
pretty strong view of China's imminent overtaking of the U.S.
Yeah, well, imminent. I don't know when, but I do think it'll probably be in our lifetime. So yeah, we'll have to have that out. We'll have that out, I think, someday. I am looking forward to that. The worst thing about all this is like, the world outside is still going by at 100 miles an hour. And I'm sort of trying to keep up.
It's the root of all evil, of strife and upheaval, but I'm certain. The big headline was a trade deal with the UK that they signed, and then tariffs on China being drastically reduced for a 90-day period. Everyone was pretty happy with that overall. You look at the tone in financial markets in general, past couple of weeks now compared to about a month ago now. A lot of the worry and hype that exploded onto the scene in early April mostly evaporated since. Rates markets have stabilized. We talked about before on vigilantism and them rising too quickly and ultimately forcing Trump's hand. So maybe he learned his lesson. He couldn't be quite as aggressive as he wanted to be there at the start. So he's toned things down. Bond market's definitely toned down. Remind me, Luke. So as you closed out the previous video, you're talking about the 10-year yield and everything that's in there. What were some of the points that you're kind of, I don't know, maybe curious about or wanted to cover next?
Kind of the point that I was making and was that, or one of the points I made was that the stock market is a lot easier to talk about, I think, from a journalist perspective, because you can just see, down is bad, up is good, and you can kind of drill in. You can see the components, what's driving it up or down. But by comparison, the bond market or the treasury market arguably is a more important market, but it's just much more opaque in the sense it's hard to figure out why it's moving the way it does. We can apply our theories to it, but at the end of the day, it comes sometimes bucks that, and you have to figure out what happened in there. So I thought it was super interesting, and I think you were going to talk about that. Some people at the Fed did kind of a post mortem at the post Liberation Day bonanza, aka sort of the liquidity crunch a little bit that happened in the Treasury market. It moved in one direction, which was expected, and then it moved in the opposite direction, which was unexpected, and they wanted to figure out why.
In general, given the United States place in the world, the US Treasury market is generally seen as the risk free rate. So, anytime you're dealing with any kind of fixed income security that's got some interest rate associated with it, you lend some amount of principal over some agreed upon time period, and then that borrower pays you some interest on that in some regular fashion up until the end of that agreement. Then they give you your principal back. Everybody does that. Individuals do that to buy homes, companies do that to fund their businesses, and countries do that to fund the operations of the country. To your point on the equity markets just being like a little easier to follow in general, up is good, down is bad. The risk involved. You're buying some stake in a company. If it does well, if the company does well, you're going to expect that to go up. If it doesn't, it's going to go down. The risk is very apparent up front. It's how well the business does. In the bond market, the main risk there is that not if the company does poorly. If the company does poorly, they still owe you the same amount, but the risk is that they're just not able to pay you that amount back. So generally speaking, that's what's referred to as counterparty credit risk. So how creditworthy is the counterparty that you're trading with? If you're talking about an individual, people buying mortgages, what's their credit score? If you want to look at a company issuing bonds, you'd probably do some of the same analysis you do if you're looking to invest in its equity. What are its cash flows look like? What's its business prospects look like? For a country, you'd look at effectively the balance of payments. How much is the country growing? How much is it borrowing? How much is it importing, exporting? What does its GDP growth look like? And so that's all a really long way of saying that treasuries are the only asset that people just don't question that counterparty credit risk component. Whenever someone buys a treasury, it's kind of thought of as the lowest bound interest rate out there because everyone else has to pay a little bit more because everyone else is some level less creditworthy than the US government. So whenever something chaotic happens in the market, whether it's, a natural disaster like COVID, a regional banking crisis like we saw in 2023, or something like Liberation Day where extreme uncertainty is injected into the market in an unexpected way, what's known as a flight to quality event is typically what people call these things. And so the flight is you're leaving riskier assets, and then your quality, you're going into US Treasuries. So whenever that happens, you typically see Treasury yields go down. What we've got here is the 10-year Treasury yield since nearly the start of the year. So now that Liberation Day is about a month behind us, what's been the net effect so far? So whenever Trump entered office, the 10-year yield was right about 450, 460 area. And then as soon as Trump took office, it started bumping downward, pretty clear trend downward, until early March, whenever some of the trade rhetoric really started ramping up more and more. Before that, people were seeing Trump as one of the most business-friendly presidents in recent memory. He was going to bring about deregulation. He was going to unleash economic growth. And they had this explicit focus on a lower long-term yield. It's something Bessent was saying, like, since the very start of the administration. So we saw these yields slowly decline. So it went from like 460 down to about between 420 and 430 until Liberation Day then. So April 2nd was Liberation Day. Market was closed that day. You look at the next day, you look at 2 days in, you fell by about 20 basis points. That's a pretty large move for the 10-year US Treasury market. That was all to be expected. For the first 2 days, you exhibited this classic flight to quality until a couple days later. In a previous episode, we touched on this lightly, but there was just extreme chaos and uncertainty in the market. And just in the investment community, there was like a developing consensus. Even though there wasn't any reason to assume this, people just felt very sure that there was going to be some weekend emergency announcement. The view was that this move is just too large and too drastic to occur. It just can't happen. The damage is going to be too great. It's, could lead to multiple countries going into recessions, all self-inflicted, just a really bad idea. So people thought, all right, Trump's going to get spoken to over the weekend. He's going to turn around. He's going to back down. And, to be fair, the couple of months before that, the back and forth with Mexico and Canada, that was the name of the game on a monthly basis. Wait until institute them on the day, and then later that day, take them off again, delay them. But for all intents and purposes, it's just he puts them on, he takes them off kind of at his own whim. So people thought that was going to happen. And then whenever that following week finally came around, we actually saw the exact opposite happen. So the end of that previous week, we saw so we went from about 420 to about 4%. And then over the coming days until that pause was announced, the 10-year Treasury yield then rose about 50 basis points. So this is really what the big head scratcher was.
Oh, this was great. Yeah, I came across.
Yeah.
So I subscribe to a bunch of stuff from the kind of New York Fed, FDIC, OCC, all the regulators, some of the big kind of banking focused news sites, and this came across my feed. Brilliant.
This was a really interesting speech. So last week, Robert Perli, he's the Fed's portfolio manager. Outsized is an understatement, but a really outsized impact in the market. If something happens to the Treasury market that's affecting this multi-trillion-dollar portfolio over this Liberation Day, that affected this portfolio in a very drastic way. So like you're saying, Luke, it's when the equity markets, a company had bad earnings. Okay, it went down. Fine. The market overall went down because a lot of companies, more companies than not, had bad earnings than had good. Okay, fine. But when this Treasury yield's moving around, it wasn't really clear. And so this was also a criticism that Larry Summers gave during that very cordial trade debate that we talked about previously. And he highlighted the fact that instead of exhibiting this flight to quality, what you saw was the United States equity markets and bond yields increase at the same time. And so that's typically something that you see in countries that are not seen as a flight to quality. You see their companies, you feel worse about them, you sell them off. Usually you go buy treasuries. If you're talking about a smaller country, people are going to sell their equities and they're going to sell the bonds there as well. So you're going to see yields go up and you're going to see equity markets go down. In the US, it was kind of the country to where that just doesn't hold. You sell your equities, but you buy bonds. So you see equity markets go down. Well, you also see interest rates go down at the same time. But there was this stark divergence in that second week whenever we saw the 10-year Treasury yield rise by 50 basis points.
Yeah, you mentioned, I imagine in the world of asset managers, one of the things that they want to put on their resume and talk about at parties has to do with the amount that they have managed under assets. How many assets I should say that they're managing. Walking around, yeah, I manage a $5 billion portfolio, I manage $3 billion. Until everyone looks pretty hot until he walks into the room, managing a $7 trillion portfolio.
Yeah, so it's stakes are really high here. So
right.
The Fed's got to know what's going on. So the speech is titled Recent Developments in Treasury Market Liquidity and Funding Conditions. So the bulk of the speech is really about some really kind of nitty gritty on the ground kind of topics, namely liquidity within the Treasury markets and then how funding markets functioned during this extreme volatility. I don't really want to go that far into detail just yet today, but he gave a really nice intro kind of describing why those long end Treasury yields increased so much. Financial markets had a strong reaction to April 2nd announcement. Risk assets sold off, like we talked about, as investors called into question previous assumptions about the U.S. macroeconomic outlook. So these starkly higher tariffs really turned everything upside down. And he goes on to say, initially, Treasury yields dropped in a classic flight to safety pattern. After a few days, however, longer-term Treasury yields started to rise sharply. And so here's the interesting part. There was a lot of speculation at the time. Very broad take was that people were maybe questioning a little bit, is the US dollar, is the US Treasury market the say-all, end-all flight to quality? If the US president's going to turn the entire global trading order upside down overnight, is it such a safe bet anymore? That was the general takeaway. And so that's, reasonably so. Okay, yeah, I could see some people allocating some of their cash away from treasuries. But it was really the speed at which this thing happened that kind of confused everyone. There was chatters and rumors that foreign holders of treasuries were feeling jittery as well, and those typically are those that have much larger holdings of treasuries. So, for example, both China and Japan, they each hold more than $1 trillion each of US Treasuries. And given the $29 trillion Treasury market, if that amount of capital is pulled out of Treasuries in a very concerted way very quickly, that would definitely have an impact. So there was people were saying, oh, China's unhappy. Are they dumping their Treasury bonds? There was just a lot of confusion. Now, it's since come out that foreign holdings of Treasuries did not decline starkly. So there certainly wasn't any concerted effort from China or Japan or anyone else for that matter to start selling these bonds in a very bond vigilante manner. So then that's just kind of all the more puzzling. People are looking for a reason as to why that happened. So in the speech, there's a very technical reason that people were talking about as well that I think Perli did a good job of offering a high-level overview about. So in the speech, he goes on to say, one factor that appears to have contributed to this unusual pattern is the unwinding of the so-called swap spread trade. Reportedly, many leveraged investors were positioned to benefit from a decrease in Treasury yields of longer maturity relative to the equivalent maturity interest rate swaps, partially due to the expectation for an easing of banking regulation that would bolster bank demand for treasuries. Swap spreads are defined as the swap rate minus treasury yield. Leveraged investors were making a directional bet that swap spreads would increase.
It all makes sense now. Got it.
I was going to ask, is that your typical, kind of go-to party conversation? I think my cousin Joey, he would definitely jump on that one.
Yeah, he would. Right. Yeah, it's just one of those things you sort of, you look over it and you understand the terms, you understand what these means, but until you actually see like the numbers and the actual trade, it's really hard to envision. You just kind of have to trust them at their word.
Swap spreads are defined as the swap rate minus the treasury yield. So we talked about treasury yields a lot. That's more or less the interest rate that the government needs to pay, that the US government needs to pay to borrow money from anyone that's willing to buy treasuries. What about swap rates and interest rate swap? Generally speaking, this is a interest rate derivative contract that's entered by two counterparties, and they agree to swap payments from floating and fixed sources of fixed income securities. So whenever an entity issues a bond, they can specify if they want to pay the periodic interest in terms of a fixed rate, you get the same amount for the entire lifetime of the loan, or as a floating rate, something that can change on a daily basis that responds to market forces in real time. This is typically done by institutional investors for the utility that it brings about. So, if you're thinking about asset managers or pension managers that have defined liabilities into the future, or companies that are coming up with long term capital plans, trying to coordinate cash flows from various business lines into one coordinated metric.
Yeah, I can tell for banks, this is very important. So banks are obviously very, one of the key risks that they're going to manage is their interest rate risk. And what that means is that they know that interest rates, they go up and down. And depending on how much they go up and down, how much income, how much net income they're going to get is going to differ. Now, banks have control over their balance sheet. So if they wanted to, and if they thought that rates were going to decline, they can position themselves. They can position the balance sheet. So playing with what's happening on the asset side, what's happening on the liability side, such that they would earn more money. They would have a higher net income if rates went down. In that case, they're called liability sensitive. Alternatively, if they thought that rates were going to go up, they would want to position it so that they would earn more money when rates went up. They want to make themselves asset sensitive. So back in the days when like rates were at zero, pretty much all banks were like asset sensitive. They're just like they were ready to make more money when rates went up. Kind of more recently, actually, there was, I think the FDIC or something published some statistics on the bank's positioning from like a market risk perspective. Banks on average in general are about neutral. So they're not right now. That's kind of meaning maybe people aren't totally sure where they're going. The way that they do that, and this is kind of what I'm getting to, one of the huge tools that banks have in order to adjust their balance sheet sensitivity is to go to the swap market. That's one of the things they can do.
So the swap market is composed of many of these institutional investors, but there's also speculators that could come into the market as well. You could ask the question like, oh, all right, well, why would like a hedge fund, someone who's taking some view on interest rates in the economy, why would they come into the swap market instead of the treasury market itself? All right, so this is a snapshot from a research paper that was published by the Fed about swap spreads and specifically why they've been negative recently. Putting aside for the moment why they would be negative, what it's showing here in this left chart, back in 2000 area, rates were much higher. The swaps rate, the red line, was all the way up here, around 7%, whereas the 10-year Treasury rate was about 6% or even a little bit below that. The last part of this chart, this blue area that's shaded in, this is on the leftmost axis. This is showing the difference between the two. So the swap spread is defined as the difference between these two items. So we see here, like I was saying, this is about 7%. This is just under 6% or so. This blue line touches up to about 120 basis points or about 1.2% of difference. So through time, you've got these things that are referencing the same underlying financial security, namely the 10-year Treasury yield, but they don't move exactly alike. If you're thinking about it purely conceptually, they should move in the same manner because you're referencing the same exact underlying financial instrument, but just by their construction, they can change sometimes. Whenever you're positive there, it means the swap rate is higher than the Treasury rate. And that's generally how things were up until about 2015 or so. And looking back, that was mostly because of what we briefly touched on earlier, counterparty credit risk. So if you bought a Treasury outright, your counterparty is the US government. You don't have to worry about that credit risk. But if you have a swap contract before around 2018 or so, you'd basically go to your bank and say that I want you to enter a swap contract with me. I'll pay you a fee to do it, and then we'll exchange these cash flows over some period of time. So you do take on the credit risk of that bank goes under possibly over the lifetime of that contract. That means that rates are going to be a little bit higher. The swap spread was positive. Around 2015, it started to become negative. So there's a lot of reasons why that happened. One of the big ones is that institution of centralized clearing in the swap market. So instead of individual entities going to individual banks and getting individual swap contracts, now there's a central clearing entity that all market participants have to go through. So that effectively removes the counterparty credit risk component because everyone is going through a central counterparty that is then guaranteeing the cash flows of all these contracts. And they've got this complicated system of how they enforce that. But for all intents and purposes, it really removed that counterparty credit risk component. So it tightened up that swap spread materially. In fact, it became negative. So now this is starting to get to the heart of the reason as to why this specific trade might have blown up markets as much as they did. So something that market speculators will do, they don't want to take directional views on the economy outright, but they want to take very specific views about the relationship between related fixed income securities. So for those kinds of investors specifically, they're typically called relative value investors. A swap spread trade is a classic relative value trade. If you're going long a swap spread, you're buying the underlying treasury and then quote unquote selling a swap contract. And typically what that means is whenever you buy the treasury, you're going to be receiving fixed cash flows. And so you go into a swap contract where you're paying the fixed cash flows in the swap. So those fixed cash flows kind of cancel each other out. Now, on the other side, you are then, since in the swap, since you're paying the fixed rate, you're then going to receive this floating rate. And so the last piece that is involved here, the leveraged component, is that hedge funds will buy that treasury, but then they'll go and finance it in a funding market. So that's typically the repo market. And basically that just means that, let's say they buy a treasury for $100 million. They can go into the repo market to a bank and say,
just like you can post the treasuries as collateral and borrow.
Whenever you do that, you are effectively adding leverage to your position. You buy $100 million worth of treasuries, that's $100 million cash out, but you can borrow $99 million against that, let's say, and then repay it at a later time. So now you've only spent $1 million to effectively take a $100 million position. And to add on top of that, now the swap spread component, now you are long this treasury security in a leveraged way. So you spent $1 million to get a $100 million position. Now to finance that trade, you're typically financing it on a daily basis. So you're paying a new rate every day. You're effectively paying a floating rate. So the other side of the swap spread trade, paying a floating rate each day to finance the treasury are effectively canceled out by the floating rates that you are receiving on the swap contract. On the other side, the fixed rate coupon that you're receiving from the treasury is roughly canceled out by the fixed rate payment you're making into the swap contract. So whenever you hold this position, you don't care which direction in which interest rates move. You care about the relative difference between the two cash flows of those underlying instruments that you're getting.
The swap and the treasury. So if there's a negative spread with that construction, you can make money, basically. So how does it get unraveled?
So since it's a highly leveraged position, very small movements in this underlying spread can translate to very large gains or losses. Prudent risk management typically dictates that if you're in a very leveraged position, you want to have a very tight stop loss in place. You don't want to have a highly leveraged position start to decline and look like it's going to fall through the floor, hope it comes back, but it can completely wipe you out. So whenever these things move against you, you want to very quickly close out that position so you don't lose too much money. And so that's exactly what happened over this Liberation Day event. So back to Perli here. He goes on to say, off the heels of the tariff announcement, swap spreads started to decline and made the swap spread trade increasingly unprofitable. Because this trade is highly leveraged, risk management dictates that it should be quickly unwound, which is what appears to have happened. So if a $10 billion hedge fund has $10 billion to invest, they can reasonably go and take on exposures of hundreds of billions of dollars. And so multiple hedge funds do this. You have a handful of them. Suddenly you're talking about trillions of dollars of exposure within the treasury market. All at once, all of these highly leveraged investors had to unwind this position all of a sudden. So unwinding means selling the treasury into the market. So you had this very sharp, very sudden concerted selling of Treasury market exposure, mostly from hedge funds, which then exacerbated this underlying trend that was gripping the market that, hey, maybe the US Treasuries aren't the sale end all risk-free rate anymore. Let's sell them. And so once that happens, hedge funds are then compelled to sell, and then they do that and they sell far larger amounts, which then exacerbates that issue even more, which then makes other hedge funds have to sell. And so it compounds onto itself. And so that's really the net effect that we had. The 10-year Treasury was kind of in free fall until that pause was made to the Liberation Day tariffs.
Oh, that's kind of interesting. Give me the trade developments.
All right, so nitty-gritty mechanics of the Treasury market and swap spreads and all that good stuff aside, we also had some trade news over the past couple of weeks now. So as I started to touch on earlier, the US and UK held a very flashy event where they signed a kind of a first phase of a trade agreement. And then a few days later, the big one really was the pause in tariffs with China. Taken together, these two events really helped increase sentiment overall. Maybe all of this Liberation Day stuff will not be as disruptive as we thought. Maybe he will take a more kind of incremental, slower approach to rebalancing the global trade system. But one of the main criticisms that the administration has faced at the same time is that these trade deals, they really don't mean anything. They're really hollow. They're very light on details. The one with China wasn't an agreement at all. It was just a pause. Critics would say that the underlying outlook has not changed. These huge tariffs are only on a short pause, and there's still pretty large new tariffs on China in the first place. So let's go into a little bit how they went on to defend these moves.
Swiss government for facilitating this trade meeting here in Geneva. We had very productive talks, and I believe that the venue here on Lake Geneva added great equanimity to what was a very positive process. We have reached an agreement on a 90-day pause and substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%. We had very robust discussions. Both sides showed great respect. We have a process in place, and now with the Chinese, after this weekend, we have a mechanism for continued talks. So process, plan, and mechanism.
He said both sides lowered tariffs by 115%. Again, it sounds pretty good, but that still leaves 30% tariff that the U.S. is putting on China, and then 10% that China is putting on the U.S. This was just a 90-day pause as well. So that's where people were saying, well, nothing was really agreed on here. They just stopped imminent disaster, more or less. So Bessent's point was that this was the first round here. It gave us a process and a mechanism with which to actually go do something now.
Yeah, quick hot tip too. If you want to I don't want to say impress, but if you want to be extremely pedantic with a finance person around, they might respect you for it a little more. They didn't reduce tariffs by 110%. They reduced them by 110 percentage points. Little different. It's kind of one of these little annoying things that happens when you talk about changing with percentages. It went down, the percentage point went down 110%. If it went down 110%, it'd be at 0. You can't go down more than 100%. Anyway.
Keeping me honest, Luke.
Well, I caught Bessent say it. That's why I kind of he said if they went down 110%. And I don't know, that's kind of one of those, again, pedantic things, but when you're writing something, it can be important to make the distinction. Here, it's clear what he means. But 5% decline in some cases and a 5 percentage point decline are two very different things sometimes. And in some contexts, it's not obvious.
Admittedly, so it was pretty light on detail. He goes on a little more and he talks about the components of the trade deficit and how he wants to attack each one's. But then one of the things he talked about towards the end briefly was that the whole intent here is to restore a healthy equilibrium in trade. And I thought it was kind of interesting how he described that in the context of what they're trying to do here.
So we are just trying to restore a healthy equilibrium. That the U.S. economy has become very unbalanced. On one side, we have a forward-leaning, the deepest and widest financial markets in the world. We have financial innovation. We have the tech sector that is the envy in the world. On the other side, we are a natural resources economy led by energy. So it is a barbell, but in between, precision manufacturing, especially precision manufacturing, has been wiped out, and it is our intent to bring that back. So we want to rebalance, and I think that there is a big opportunity. If I think about this weekend, the Chinese, they have gone the other way. They are unbalanced in terms of overproduction in the manufacturing sector. They have stated, but have not yet rebalanced toward a more consumption-oriented economy. And there is a chance, if we can open up trade to China, have more fair trade toward the U.S., that we could rebalance together. So I reject the notion that business as usual would have worked.
Great. And I think this will be.
Does he seem kind of like nervous to you? He seems kind of out of it. Or is he just super tired? He's kind of like putting sentences together, but he doesn't. That was not the most coherent thing, frankly. He talked about the barbell, and then he talked about how China started talking about manufacturing and then like switched to consumption and then just flipped back to, I reject that business as usual would work.
Oh, well, sorry. So the question that prompted that answer was saying more or less, why are we even here in the first place? Why couldn't you have just called them like this without the Liberation Day stuff? And so that's really what this case. But I thought it was pretty good just talking about how the U.S. and the Chinese economy, like their strengths are in different areas. So in China, clearly they're very strong in manufacturing. The U.S. manufacturing has very much deteriorated in past decades. On the other side, the U.S. Their tech sector, financial sector, this service-driven economy is really second to none. And China has stated intentions to become a leader in those areas as well. So I kind of took it as, China's good in manufacturing, not as good in tech. US is good at tech, not good at manufacturing. If we're really good at if we do a really good job with these trade deals, we can rebalance both together. Both sides can achieve their goals. China wants to become more consumption driven. The US wants to bring back precision manufacturing of items related to national security. Those things kind of offset each other. So in the best case scenario, maybe we could solve both problems at once. What do you think, Luke? Do you think that's plausible or just too much to ask for?
I guess sure. I guess the part that I was kind of confused at was the inclusion of the consumption part. I mean, it's one thing to talk about which industries you're sort of good at, and then it's another to talk about where the GDP component comes from. Is it the G? Is it the I? Is it the C? Right? Is it the government expenditure? Is it the net import export? Is it the consumption? That's kind of what I meant by I didn't really see how those two were.
So he didn't say explicitly, you're right. If you're making a lot of things and exporting them, you're not consuming them, obviously. But in contrast, if most of your activity is coming from creating online services or financial services, and presumably people are buying and consuming these things, which is what happens in the US a lot.
Yeah. Okay. I can see that.
And that's kind of where we're at right now. Financial markets don't seem to mind. They think we're in a much better spot than we were on Liberation Day. But then that kind of raises the question overall, like, what was the point of this Liberation Day stuff? Like, it kind of brings me back to the first couple months of Trump's term where he was picking and choosing very targeted individual countries to really come at hard. He did it with Colombia. He did it with Canada. He did it with Mexico. He did it with China. Was it really necessary to apply that very drastic move to every country in the world? And if he was just going to come back and pause them anyway, what was the point?
Well, to get to the negotiating table, I guess. I don't know. I mean, I remember we were kind of talking about this, and we were saying that this is going to be these tariffs are going to be, political. They were just to get them to the negotiating table. And then we had that episode. Oh my God, you guys, they're economic. There are formulas. It's pointing to trade deficits. The tariffs are just supposed to bring it back together. And now what? You're going to say we're back to political? We're just getting back to is that what you're telling me, Joe? Joe.
That's what it's certainly starting to look like.
Joe, just tell me what's going to happen. Okay. Can you just tell me what's going to happen? Enough of this. Make a prediction.
Yeah.
Let's go. Think about it for a second.
My prediction, I think it's going to go down this path. I think it's going to go down this piecewise, very slow and steady path. I think he's going to have all of these things like on indefinite pauses, but he's going to continually say, the tariffs are still there. They're still coming. They're just on a pause. And he's going to try to work them out before that pause ends. And if he doesn't, he's going to extend the pause. And in effect, that's like you were just saying, it's more back to a political effort to do. And that's the approach that he took in 2018, 2019. Some people were getting a little nervous about trade at the time, but looking back, there was absolutely no issue with inflation. There was no issue, any hit to economic growth or anything like that. But what he achieved with those deals was quite small. So I think he just wanted to achieve much more very quickly, but was corrected by the bond market. And now he's just moving back to this slow and steady approach.
All right. I'm gonna stick with my prediction that I made 2 weeks ago, kind of before this happened. Not much is going to change. It's just too structural. Too many barriers. Too much structural stuff from the Chinese side. I'm going to stick with that.
That's definitely the other view, that like the China politics view. They can just wait all this out. They can wait until Trump's out of office. She's still going to be there in 4 years, where Trump will not. So they could just cross their fingers that another Joe Biden comes in and they just literally forget about the trade deals that Trump put in place with them, like Biden did more or less with the phase 1 deal.
Yeah, they didn't quite make, they didn't really keep what was said. But then, the COVID, that's kind of what was been blamed.
Yeah. Well, we had some economic data this week as well, but I think we're just about out of time here.
All right, man. Fans are waiting. We're knocking on the door of 100 subscribers.
That's it. Yeah. No,
that's a big one.
We're in the 90s.
Here we go. Them all. Yeah.
All right. Well, that's about all we've got for you this week. Another episode down here. I'm Joe.
Luke. I'm Joe. I'm Luke.
Who are you?
I'm Luke.
And I'm Joe. Thanks for tuning in. We'll see you next time.
All right.